Independent from left-right politics, it's qualitative listening with your host, Kimmy Chandler. Hello, America. I'm Kimmy Chandler, and this is qualitative listening. I wanted to take a second to talk about the big, beautiful bill. Trump has been calling for the Federal Reserve to lower interest rates, but I've been reading reports that this bill will in fact raise interest rates. So when people say the big, beautiful bill, they usually mean a big fiscal package with large tax cuts, big spending on infrastructure, border security, or manufacturing incentives, sometimes tariffs or other trade tweaks. In macroeconomic terms, that's fiscal stimulus, more money flowing into the economy. 1. It would boost aggregate demand. More government spending plus tax cuts equal people and businesses have more to spend. This pushes aggregate demand up, so output and income rise in the short run. If the economy is already close to full employment, this extra demand mostly causes higher prices, rather than just more production. 2. Higher inflation risk. More demand equals businesses raise prices. Workers may push for higher wages. This is classic demand pull inflation. 3. The Federal Reserve will likely raise interest rates. The Fed's main job is to keep inflation near 2%. If inflation jumps above that, the Fed responds by raising its policy rate, the federal funds rate, to slow things down. When the Fed raises the Fed funds rate, borrowing costs for mortgages, car loans, and business loans go up. Short-term and long-term interest rates generally move higher. 4. Higher budget deficits can also push rates up. Big tax cuts plus spending usually mean bigger deficits if they're not offset. The government has to borrow more by issuing more treasury bonds. More treasury supply means bond yields tend to go up because investors demand higher returns. Some market interest rates rise too, even aside from what the Fed does. Can this be offset? If the bill includes big productivity boosts like infrastructure or energy projects that make businesses more efficient, it could help reduce long-term inflation pressure. But in the short run, the demand boost usually hits first, so rates still go up. Alright, that's the show, folks. Thanks for listening to Qualitative Listening.